Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Max Kettner of HSBC writing, Goldilocks has had a few scratches in the last few weeks. Data misses have started to cast some doubt over the idea of US exceptionalism. However, we'd argue this is precisely what we're looking for. Max joins us now for more. Max, good morning.
Good morning.
Welcome to New York. We've got a lot to catch up on. What's that last line about? This is precisely what we're looking for.
I think overall, if we think from a more strategic perspective, then actually this is the kind of stuff you want for US exceptionalism. Because the problem is, think 2 months back, the consensus opinion was you got to buy the dollar, you got to buy US equities. And actually, when we look at anything else, don't even look at it. It's not even worth looking at. It's just the US and nothing else. And here we are 2 months later, and all of a sudden nothing's worked. So one of the key ingredients for both this idea of US exceptionalism, but also the idea of Goldilocks is that you've got these persistent doubts around it. That people are saying, "Oh, AI, how are we going to make money with AI?" And how about this big discount of the rest of world equities, international equities versus the US? Isn't the US too expensive? So this perpetual question around valuations. Now that's the strategic question, right? And you're saying, hey, that idea of US exceptionalism is not dead. Absolutely not, because we've got lower corporate taxes, the S&P effective tax rate is much lower. Your ROE gap, I think I would always argue, look, you can look at valuations as a really, really negative sign from a longer term perspective in the US, but you can also look the other way around and say your ROE gap between the US and the rest of the world has more than quadrupled in 15 years. So fine, you're paying a higher price, but guess what? You're getting more than 4 times as much profitability. Again, that's the strategic perspective. Doesn't tell us, unfortunately, an awful lot about the next couple of weeks.
This has been the most exhausting 5% pullback I think I've ever witnessed on the equity market on the S&P 500. Do you buy this weakness or chase the strength in Europe with banks up 25% year to date on the stock 600?
Yeah, I'd rather look elsewhere right now. So we've just put out a note this morning saying, look, guys, probably the US is not the place to be right now, at least tactically, because those tariff headlines are probably not going to go away. I think for the Fed put to come back into action, there simply isn't enough weakness yet, right? So you said this has been the most exhausting 5% pullback, and I feel it. I think all of us fall for
Have
that.
you ever seen anything like this when sentiment seems to have shifted so much, but the market's only done so little?
It's amazing. I mean, it is. We've actually done some analysis on this week when we look at some of our positioning and some of our momentum indicators. The drawdown that we've seen so far is almost only half of what we would usually see when our indicators go down by that much, right? So you've got a big shift down in those positioning indicators, but normally you'd say, yeah, that's probably like 6-7% down, but by that time it was only 3-4% down. Well, so that is exhausting, I get it, but the problem is for the Fed put to come back, we would need more weakness. You're saying 5%, yeah, fine, but is the Fed really going to go in and it's like, oh my God, Nvidia's down, so yeah, we need to cut rates.
Well, hold on a second. There is this question about the journey mattering, and this has sort of been a theme over the past couple of weeks. How much does the journey matter if the destination is a good one? And we're talking about how it's only a 5% pullback, but it can be up 10% and then down 20%, and then eventually we'll get to 5% in one day. So it raises this question about risk-reward models at a time where you cannot model this type of volatility. You cannot model a headline risk. How much is that alone pushing capital away from the United States right now?
I think on a tactical basis, yes. I think on a tactical basis, Lisa, that's exactly what you want to do. When we look at the US, if you had predicted what's happening now from a policy perspective in the US, if you had told me that a month ago, I would have said risk off everywhere. Don't buy Europe even less. Don't buy China. Don't buy EM. No, don't buy anything. Now you look at it, I'm like, actually, you know what? Europe's really looking great. Like Germany, as a German, I look at this, I'm like, this is as watershed as you can imagine. right? Like the Germans spending money, and I know that from myself, right? To get myself, I'm in New York, and I'm just like, really? Coffee, $7? I'm like, I'm not going to have coffee. Actually, no, I'm going to go to the Bloomberg office every day, get my coffee for free, and then I'll go away, so I don't have to spend money.
You can borrow money.
Is, you know what I mean?
You can spend it on
but it is genuinely, it is such an extremely watershed moment for Germany. And then you look at the banks, and we've just, when I came in, it's like 25%. You still want to buy that? Heck yeah. Absolutely.
So when do you think that the optimism has gone too far? We were just talking to Jane Foley, trying to pour some cold water on this optimism that we're hearing around. When do you know that we're overstating it or understating it? What are you looking for?
Once you stop having the conversations about should we worry and what could stop it, I think then we're there, right? So it's a bit like with the idea of US exceptionalism at the end of December, beginning of January. Once everyone's super bulled up, then yeah, fine, you're probably done. But to be honest, when you look at positioning indicators, when you look at flows, certainly flows have been starting to come back into European equities, but they've only just started. Right? 2 months ago, you'd have said, why are we even looking at Europe? What's the point? Right? What is the point? And now we look at it, I'm like, wow, this is like the best thing ever. It's been 2 months. It might, again, because it's so exhausting, it might feel like 2 years, but it's genuinely just a couple of weeks. I'll give you an example. I was in Frankfurt literally 3 weeks ago. The amount of conversations with clients I've had about fiscal stimulus, about infrastructure and defense spending was zero. Absolute zero. Because 3 weeks ago we're like, never going to happen. Come on, you need a 2/3 majority. Come on, why are we even talking? Yeah, let's talk about the next thing. It's 3 weeks ago. This is as watershed as we can imagine. And then you look at, you look away from the US, and you're saying, hey, why would I not buy German mid and small caps or European small and mid caps? You look at China, you look at the HS Tech trade, right? The broadening AI trade. You look at China Internet. Yeah, that still makes sense. No? You look at Japan, hey, rates probably going also a bit higher. Japan banks, fine, they've rallied a lot, but with rates maybe going another 25 bips higher than the market is currently pricing. Great, still good for the banks. So you look outside of the US, and there's loads of things happening now that are actually really uncorrelated to the US. Whereas 4 weeks ago, I would have said, if this happens in the US, everything's going to be, correlation is 1 and everything's going down. And it's exactly the opposite, which is in fact really good. We guys have this conversation about correction and exhausting 5%. If we were sitting in Frankfurt, we'd be happy daisy. I mean, we'd be like freaking cowboys right now.
Are you and your Frankfurt German friends thanking the President of the United States for this?
No, I think, that's probably a bit too far. I honestly also don't really care what the
catalyst is.
Sort of the catalyst is. The important thing from a market perspective is, number one, is it happening? Is it likely happening? Number two, is it sustainable? And that looks like it's happening.
You have a lot of conviction, though, that this is happening and will be sustainable. You don't think this is a head fake from the German politicians?
I think we've gone too far for that to be a head fake, right? For that to be like, oh, actually, never mind. Like, we just thought we're going to spend 800 billion,
I know Europeans
but
can
that's
be pretty
fine.
fickle when it comes to spending.
Yeah, but that is mostly red tape and mostly bureaucracy, right? That is, and I think that's more the longer term issue. So then we get to your question, like, is this a head fake? Tactically, it's not. Is this a great 3-6 month trade? Absolutely. Is this the watershed moment where we're burying US exceptionalism, and the next 3 to 5 years we're only buying European equities, and now European profitability is going up relative to the US? Probably no, because you've seen what Draghi was saying 2 weeks ago around implicit tariffs within Europe, that we've got implicitly 45% tariffs within the EU on goods and 110% on services. You look at the EU recovery fund, it's the uptake on the recovery fund from almost 5 years ago keeps being subpar and subpar, because it's not like corporates don't want it and governments don't want it, but there's so much red tape, so much bureaucracy within the EU, right? That needs to be tackled. That's not going to be tackled with infrastructure and defense spending, but those are two separate things. We can talk about the strategic asset allocation decision, the 7 to 10 year decision, or the sort of 6 month decision where you're saying, is the spending the watershed moment for the next 6 months? 100%.
In 6 months' time, can the bond market absorb it when we're having a real conversation about a massive tax bill going through Congress here in the United States?
I think so. I think you mean in Germany as well?
I mean the global bond market.
Yeah, global.
Germany's issuing more. US might have to issue more. What does that look like?
But I think Germany traditionally basically starts issuing more on bills. So that actually, at some point, I think will be bringing in natural buyers for bonds. It still means, obviously, as we get more issuance, that probably bonds are going to continue to cheapen versus swaps in the next few weeks and months. But that trade's gone an awful lot already. But, I'm not particularly bothered. I think in the US, I'm also not bothered because, we can look always at the government debt side of things. But when we look at the private corporate debt side of things, massive deleveraging in the last 15 years. No? You look at net interest payments of corporates. When you look at those, we're like on a 20-year low. Because, corporates have been hoarding cash, they get the high cash rate, and they've locked in maturities. You look at the S&P, you got almost 60% of debt that's maturing after 2030. Why would I? When people are like, oh, yeah, but there's all this debt from corporates, I'm like, great, call me in 15 years. I don't care. So from that, the corporate sector and the private household sector actually looks way, way more healthy to absorb sort of that bigger issuance.
The Europeans just sound so happy right now, don't they? What a change.
When have you never seen me happy? Yeah. I blame the coffee. I blame the free coffee.
No, so,
give the German free stuff and he's happy.
All I can say is watch him go buy a $7 cup of coffee and all of a sudden these fiscal stimulus plans, they're real.
Yeah, come back when it's like euro-dollar 120, 125, back to 150 again. Max, it's good to see you.
Thank you.
That'll make a difference. Max Kettner of HSBC. Foley of RaboBank writing, the return of US growth concerns has clearly been a drag on the dollar. However, the change in the fundamental drivers behind the euro have been even more dramatic. Jane joins us now for more. Jane, welcome to the programme. I have to say, we talked about this a little bit earlier this hour. It takes time to internalise a shift this large on the continent. It would take weeks, months, maybe even years. Jane, could you just communicate from your standpoint how large a shift we're seeing from Germany?
Well, certainly it's a significant shift in terms of the news that we've had. But of course, everybody in Europe is aware that things take time in order to come into fruition. And this is a real issue, I think, for the people who've been buying euros, aggressively this week. Is this just a sugar rush, or will we actually have a different determination of the time frame it needs to get this money through from Germany, from the EU, into the economy, into the defence sector? And if there are disappointments along the way in terms of that timing, well, we could see 105 again in euro-dollar and potentially quite quickly, because we know that there are hurdles. We know that if this change in fiscal policy gets through Germany, well, it's with the outgoing parliament. The new parliament after March the 25th could have legal challenges even to this. And then what about capacity? Europe doesn't have huge capacity in terms of defence. How quickly can it actually spend all of this money? So we know that the timeline for Europe could be quite disappointing.
So, Jane, you raised your forecast to euro-dollar to 107. You said that you're going to update that by the end of this week. That means you have one day to really look at all of the facts and figure out how much is real and how much is overly optimistic. What are you looking at to make that determination, and what's the range of potential outcomes?
Well, I do think anything from the Fed is going to be really important here, because, we're hearing the arguments about the slowing in US growth. We can see also, the stock market and how that in the US could affect confidence for the US consumer. But even though if we were to accept the fact that the US economy is slowing, well, what about inflation? Because, maybe we were a little bit optimistic or pessimistic in terms of the inflation push from tariffs at the start of the year. But tariffs are still inflationary, and even if the Fed is worried about growth, it's unlikely to cut interest rates aggressively if it's concerned on the inflation front. So I think that's a really important part. To what degree are the Fed able to cut interest rates in an environment where inflation has been looking sticky? It was looking sticky because of the Biden month, through the end of the Biden administration, likely to look sticky now because of tariffs. And we just don't know the impact of those tariffs. So the Fed likely to be cautious on that front. So whereas that could give the dollar a little prop higher, it's possible that the worries about timing, about German fiscal spending, could actually knock the euro a little bit lower from the perch that we've seen over the last couple of days.
Although if you take a step back, Jane, I wonder if Bob Michael is onto something and whether you would agree with this idea that more broadly, maybe it's not this week, but maybe it's this month, maybe it's the next couple of months that we're seeing the peak in dollar exceptionalism. And with all of the money looking to be raised elsewhere, there is going to be a sucking sound away from the United States in dollar assets.
Well, I think this is a question really about U.S. exceptionalism, really for the next decade, for the next 2 or 3 decades. Even I don't think it's going to be able to be answered in a very short term. I mean, to me, one of the definitions of U.S. exceptionalism is the fact that the dollar has its own fundamentals, and that derives from the fact that about 50% of the world's invoices are in dollars, and that means that even when negative news comes from, say, the US budget, people need their dollars. They buy their dollars. That's why it is essentially a safe haven. And for that to change, we're going to have this very slow, and it's already started, this very slow progression away from using dollars as an invoicing currency, and therefore, as a reserve currency. That has started. It's quite possible that Trump's policies with respect to Europe, with respect to Canada, Mexico, etc., make people move away from the dollars. But that is a very slow process, and I don't think we're going to be able to answer that question quickly.
Well, what fills the void, Jane?
Well, precisely, and that is why the movement away from the dollar use of the dollar internationally will be very, very slow. I mean, clearly what we've seen over the last few years is, China wanting to use the renminbi as more of an invoicing currency, for instance. That will carry on, and some of its trade allies will continue to, be pushed in that direction. It is going to be interesting to see whether or not there is a European response over the next 4 years. That perhaps will depend what happens between Trump and Europe in terms of tariffs, for instance. But again, I think the question about dollar de-dollarization is a very slow one.
Hey, Joan, appreciate it. Jane Foley there of RaboBank on the shifts we're seeing out of Germany. Here's the latest this morning. Markets looking for more tariff relief from the Trump administration, delaying levies on auto imports for a month. Jason Furman of the Harvard Kennedy School writing, "I've rarely seen an economy turn negative as quickly as this one has. But people shouldn't get over their skis. I expect all of this to slow growth and add to inflation. But don't expect anything dramatic in the data right away." Jason joins us now for more. Jason, welcome back to the programme, sir. And I'm totally with you. I think we all are. This shift we're seeing in sentiment in just a month, so big and so quick. Where does that more constructive tone come from at the end of that quote there? Why should we ultimately avoid anything too dramatic?
Look, there's no debate that the Trump administration's impact on the economy has been negative. Just about everything they've done has been negative for the economy and is going to hurt it. You can debate the magnitude, and partly I'm reacting to, there was the Atlanta Fed's GDP Now said that the economy was cratering in the first quarter. I think that number was flawed. Things move slowly. Consumers are really, really nervous. But my guess is that they're probably still spending, and they're going to wait and see how things turn out. So the types of problems we're seeing now, they take time to build. They don't just go straight to recession.
Jason, we do have a carve-out, though, for the auto sector, and there's lots of conversation. Maybe agricultural will be next. If you're USMCA compliant, you get a carve-out. Basically, does that mean these 25% tariffs came and went? And what's the impact going to be?
There's tariffs that are going to come, there's tariffs that are going to go, and then there's more tariffs that are going to come back. I mean, you just showed Howard Lutnick. He expressed pretty clearly that there's going to be more and more and more, and as he just said, they're going to stick. So, yeah, you can do carve-outs, but there's still lots and lots and lots of tariffs on Canada and Mexico. And remember, we're less than 2 months in to this administration. In Trump's first administration, it took him nearly 18 months to get to the first set of tariffs. That was after an extensive and judicious process, and it was on a much smaller set of imports than anything we're seeing now.
What do you make of the April 2nd argument that they're looking for reciprocity, basically trying to make sure they can rewrite the rules of trade so that it actually is, in their mind, free and fair?
We already have reciprocity. If you look at other rich countries, their tariffs against the United States tend to average about 1-2%. Our tariffs against them average about 1-2%. On average, they're the same. Now, there's some things they have higher tariffs than we do. Some things they have lower tariffs than we do, but they average out to about the same. So we have reciprocity. If they want to sit down and do a free trade agreement and get those tariffs from 1 to 0, I'd sign up and be wildly enthusiastic.
Jason, you said that it takes time. This is a barge, and to shift the U.S. economy will take more than just a couple of weeks of bad sentiment. At what point do you think that we'll actually start seeing some of the uncertainty and some of potentially the expectation of higher prices begin to show up in the economic data, the hard data?
Yeah, I mean, I think you're going to start to see it right away, but it'll start pretty small and grow. Some of what I'm most worried about here is actually what it does on a 5 or 10-year time horizon when you're talking about how businesses think about their integrated supply chains, how they organize themselves to have maximum efficiency. Now they're going to have to think how they organize themselves to be resilient against an extremely uncertain political system. But, I think you'll start to see it a little bit right away, but it'll really grow. And of course, it depends on, do these tariffs escalate or do they, end up dropping all of them? And of course, anything is possible.
This is a pretty significant regime shift, at least when it comes to tariffs. And yet what we've been talking about a lot of this morning has been Europe and has been China and has been what's going on there with respect to fiscal stimulus and supporting their defense sector. And it's raised this question that J.P. Morgan's Bob Michael raised yesterday, where he said, we saw the peak in U.S. dollar exceptionalism this week. Do you agree with that? Is that something that you're seeing in terms of the slow drip feed of rearranging supply chains and even maybe invoicing that we see around the world?
I feel pretty good about the dollar and pretty secure about the dollar, although if you wanted to do something about dollar supremacy, you would throw a massive amount of uncertainty into the U.S. economy, which is what we're seeing right now. But I think even that won't be enough. And look, what we're seeing in Europe is good. I'm glad that Germany is untying its hands. I know that's a little bit for the bond market to adjust to up front, but absolutely the right move. And Europe has been behind in spending on its own defense. They do need to shift to something more like closer to a wartime economy so that they can really be in a better position to defend themselves.
They've been massively behind. Jason, it's good to hear from you as always. Jason Furman there of the Harvard Kennedy School. I think you referred to the US economy as a barge, more like a supertanker. Joining us now, Constance Hunter of the Economist Group. You're very worried about that, aren't you?
I am.
Constance joins us now for more. Constance, welcome to the programme. Let's talk about the jobs data first. So no drama in jobless claims. That's good news. Are you expecting any drama in the payrolls report tomorrow morning?
We're expecting a softer payroll report than we've seen on the 3 and 6 month average. So I would say about 180,000. What we're going to be looking for, though, is under the hood what's happening, right? So it's not just government employees, but that services employees and consultants. That's where you've seen a lot of layoffs, right? So there's a multiplier effect from what's happening. And so there are a lot of people on the job market with very highly qualified skills. If we continue to have a fairly strong labor market and strong economy, I think those people will get sort of hoovered up into other jobs. But if we don't, then you're looking at some more longer term damage to the U.S. economy.
Constance, we were talking earlier this morning about this being really a big economy that takes time to really damage, and that some of the sentiment shift has happened a lot quicker than the actual underlying data. Would you agree with that?
Yes, absolutely. I mean, one of the things that we look at to think about forecasting payrolls is the ISM Services Employment Indicator, and that is still ticking up, even though that's really a real-time indicator. But another thing that we look at that's really valuable is an uncertainty index that combines three things. So it combines uncertainty gleaned from actually EIU documents on our own website. Behind our paywall. It looks at changes in the tax code. So, of course, we have the TCJA up for possible extension. And then it looks for differential between economists' forecasts. And when we look at that index, when it has spiked up, it has presaged a recession is coming. And we are at levels that are well above the 2008 financial crisis, well above what happened during the dot-com bubble, and well above what happened in the 1990 S&L crisis. We're not quite at COVID levels, but we're pretty elevated. And so what we're doing is we're using that to forecast how is this going to impact CapEx, how is this going to impact household consumption.
How reliable has that kind of sentiment data, though, been, Constance, at a time? And I know that there are other things that go into this, but right now some people are pointing to the sentiment and talking about how negative it is. And Marie's been talking about the Beige Book all morning, and she's right. And the word uncertainty or some variation of that came 47 times in addition to the 49 times of tariffs. I'm just wondering, we're not seeing the shift, though, in consumer spending habits just yet. I mean, people are worried about it, but we're not seeing it. So is there a chance that what people say and feel and what they do just isn't going to cohere like we've seen in previous cycles?
So are humans going to keep being humans? Yes. we have a lot of dichotomy, right, in between what we say and what we do. So yes, that's a significant possibility. And I think we also have to think about some of that front loading is happening in terms of consumer behavior as well, right? People buying things, if they were planning to buy a car this year, maybe they're saying, well, maybe I should buy it now rather than wait until April or May when perhaps it will be more expensive. With that said, though, rarely have you seen this level of heightened uncertainty without seeing it cause some pullback, both in capital expenditure and consumer behavior. I would say one thing underpinning this that we have not necessarily had in previous cycles, right, is we really are in the midst of an incredible productivity boom, and that could give us a bit more cushion than we would normally have. And then the other thing is that the Fed knows that it can afford to wait should things get wobbly, because we have such an immense amount of mortgage equity in homes. And so you saw yesterday, all it took was the slightest move down and you had a huge increase in applications for new homes and applications for refinancing. So there's a lot of capital there on the sidelines to be deployed in the economy should we get into a weaker situation and should the Fed need to lower rates.
Constance, what kind of impact are you seeing DOGE have on the labor market?
I mean, right now, I would say it's negligible, right? Like, we didn't see it show up in claims. It's a large economy. So yes, these federal workers are getting laid off, but they're really highly qualified individuals, generally speaking, right, with advanced degrees and important specializations. So if they're not rehired by government, once people realize that they were actually doing valuable jobs, then it's very likely that they'll get rehired within the economy. And then, of course, some people chose this opportunity to take an early retirement.
Constance Hunter there of the Economist Group. Constance, thank you for joining us to break down the latest on the labour market.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.